I'm looking for Peter. Peter, did we have people sign in? Did you guys sign in? Yeah. Okay, good. Okay. Just making sure because we have a couple classes in here and I want to make sure that people have signed in and things like that. So I am going to introduce you. I'm going to have them introduce themselves, actually. So first of all, my name is Christina. Most of you guys have had me for class, or at least half of you guys have had me for class. And the other half of you have had Professor Holmes or Professor Rao, who is somewhere here, over there in the back. We have eyes on all of you. No, I'm kidding. It's fine. But one of the things that I do here with Dr. Holmes is we co-lead the Entertainment Industry Institute, which we bring speakers in and to CSUN to help connect you guys to the entertainment industry in all of its facets, and the entertainment industry back to CSUN. Then I'm also the executive director of the CSUEA, and this is how this evening held, because Ilan is one of my board members. And so I'm so grateful. And so he is so lovely because he reaches out and says, how can I support? What can I do? How can I help? And what he means by that is not just how can he help me in terms of the CSUEA, but how can he help all of you, right? In terms of getting to where you want to go and help your understanding of what the entertainment industry is grow, right? So we have his firm, I have to look back because I'm so dyslexic. I would say so GHJ. Thank you. We got the chorus behind us. I'm going to have them introduce themselves because he has a couple of members of his team. And so here's a special fun fact. Ilan graduated from CSUN.
Hey.
Yeah, right? So yay! And he is literally a thought leader in the world of forensic accounting and complicated realms of finance that I don't understand. And I'm going to have questions for him tonight, just so you guys know, right? And then we also have two members of his team, and you are Long Beach, right?
Yeah. Cal State Long Beach.
Cal State Long Beach. So CSU.
Not quite CSUN, sorry, but still CSU.
CSU though, little CSU love. We're all one. We're all one. And then also CSUN. Woo!
I'm the black sheep here, apparently.
We love you all.
Thank you.
Okay. So tonight they're going to take us through for a presentation about film and TV profit participation. And just so you guys know, I've already told them I will have questions. There are things like, why did I not see a return on my investment in this film, right? It might get super personal for me, so forgive me. All of that kind of thing. But one of the things I wanted to tell you guys is they have a PowerPoint. Don't be scared by a PowerPoint. Consider this a conversation. So when you don't know a term, ask, raise your hand. It can be the stupidest question, we don't care, right? This is a realm of the industry you rarely get the curtain pulled back from. So allow yourselves to learn about it, because whether you're a writer, whether you're a director, whether you're a producer, whether you're an emerging executive, whether you are thinking you might go into accounting in some form, this will be relevant to you because it's how money travels. And we're all really interested in how money travels because I'm really interested in how money travels to my bank account. Right?
Yeah.
Right?
Yeah,
Exactly. Exactly. So I actually have to ask all these questions of how money travels to my bank account. And I have to ask that continually of studios, of production companies and things like that for me to understand how I'm going to freaking get paid because I'm an indie producer. So I always say, I'll get on the back end. Which means a whole lot of crazy things. Right? They're like, these guys are like, oh my God, why would you do that? Okay, so I'm going to have you guys introduce yourselves first of all, and then just go. But you guys need to know, ask questions. Nothing is stupid. It's a closed room, right? So ask anything that doesn't make sense.
Thank you. That was great.
Yours is so loud.
I know, his is loud.
Because I need to project. So, and I'm going to stand over here because I feel that
No, you're fine. I just press buttons,
All right.
so you're fine.
So really quickly, my just from an introduction and history perspective, my name is Ilan Haimov, graduated here, and seems like a long time ago. Literally 2 weeks before the earthquake hit back here in 1994. That's how many years ago I graduated. I have visited the school a few times, but every time I come back, I don't recognize it anymore. I have been in the profession for a very long time. I'm a partner at the firm GHJ. The three of us actually work in the same department, and that's part of the reason I wanted all three of us to be here. So, Heather, why don't you kind of quickly tell me what you want?
Thank you. My name is Heather. As we discussed, I'm CSU family, but not for CSUN, but that's okay. I also graduated a very long time ago, but I'm not going to give away the year because I'm so self-conscious about it. I'm still. I have been doing this a while. I've been at the firm for 7 years now, but then prior to that, I did 11 years in actual forensic accounting, not in the entertainment industry. So my background is litigation and forensics, but then, you know, you get an opportunity to kind of come over to this industry and it sounds way more exciting. And so I've been doing it ever since. And we all kind of have our own studio teams, but I managed Lionsgate and Legacy Fox. So those are my key studios.
Awesome. Thanks for sharing, Heather. Oh,
It's on.
yeah, right. I project a little bit more. Use my big boy voice. Hi, everybody. My name is Raul. I'm a CSUN graduate, like previously stated. I graduated in 2020. I was I was an accounting major. Started my career off at PwC doing like audits, and that's where I kind of got a good understanding of like financial reporting, GAAP, a little some accounting stuff. And then I got picked up by GHJ coming up on 3 years ago, where, you know, I joined the Profit Participations Group, and, you know, it's been an awesome ride so far.
Okay. All right. I'm going up.
Might be me. You ready?
Yeah.
Okay.
So, it is pretty loud, huh? You guys can, is it too loud? No. All right. Okay, good. So, I want to give you some background first, so you know just the playing field of what we're going to cover. But before we do that, our firm has different functions that handle the entertainment industry. The word entertainment is very wide. It's not only film and television, but we do have a variety of services across the firm. We're just under 30 people, focus on probably most of the time, 90% of the time, on film, so motion picture, and television series related. We use the word audit. It's confusing. It's not really audit, but it's a forensic review, because ultimately we do forensic consulting work. We're not performing financial audits, which is a different world altogether. That is what we do every single day. But the one thing that I wanted to share with you that is extraordinary, but it's true, that's the statistics. We have audited, maybe I should set over here, 80 of the top 100 grossing films of all time, and well over half of the television series that are deemed to be the most successful television programs ever. So we're covering a ton of programs everywhere. All right, let's go to the next slide. And just to go a little bit more into the world that we live in. So our best guess is that there may be no more than about 20 more experts around the world that do what we do. So 30 plus 20, there's about 50 people around the world that do what we do. And it's a very unique specialty. And we do probably our best guess around 80% of the work around the world in film and television. So any film and television program that you might like, there's a good chance we may have touched it at some point. All right, and then we do have a ton of work. So and I think you mentioned that already, we specialize at the level of the studio. So for example, I think Raul and I work together in auditing Sony Pictures. I think we have been working together at Warner Brothers, and then more recently at Disney as well. So and Heather and I work together at Disney. So there's different groups within the firm, within our group, that specialize at the level of the studio. And then really quickly, we do get involved, and this is the fun part, those of you who really enjoy it, financial projections and models. We do get involved more and more with valuations, which we can get into a little bit later. Yeah, you have a question or a comment? Okay. But anyway, we'll get into all of that later, but what we're going to do, I think we've heard that already. We're going to stop and make sure that we're steering in the right direction of interest to this group. So feel free to stop us and ask questions at any time. You have a question for me?
Yeah, I do.
Yeah.
When you say deal and settlement negotiation, are you guys pretty much like the middleman in terms of negotiating the deals, or what is that?
Great question. So this is more to do with, so we would be hired by, say, a producer. We would complete the audit process, and then we actually assist in the process of negotiating what we're fighting. So it's more to do with the negotiation of our audits.
Yeah, we have the meetings. When we have a settlement meeting, it's us on the call, but it's mostly the studio talking to the client, basically saying we agree with this claim, we don't agree with this claim, we'll pay you X amount of money, and then we're kind of there to explain our claims. Eventually we have to hop off because they don't want to let us know what they're agreeing to. So we kind of are hidden in the background after that point, but yeah, we're involved in those conversations.
But I do want to go back to, we are though, not for many clients, but some clients come to us when they negotiate a new deal, and they asked us, can you just take a look and let us know if there's anything here that we should be thinking about and adjusting, and we do it. So in other words, not often, but periodically we get asked by clients. So that would be the deal negotiation process side, but we're mostly, so if you look at the 20/80 rule, most of our negotiation and assistance is actually in the conclusion of the audit process.
Yeah, I understand. It's almost like you guys are like in a more so advisory role rather than telling people exactly what to do. We get, hey, this is what you could do, but it doesn't have to do that. So
Right.
I understand. Thank you.
We have a client. Hey, you're a new client. You have a question back there.
So you said forensic accounting. So are you basically talking about when, like, for example, Napoleon Dynamite, and they were saying, "Oh, we have no money for you. We have no money for you," and then they hired forensic accounting firm, and they were like, "Look at this. There's so much money that you didn't tell us we had." Is that basically what you guys do?
Exactly what we do.
Did you know there's a Napoleon Dynamite statue at the Fox lot? You review that. Did you know that? Yeah. So
I've seen it.
And we've been involved in auditing that. Yeah. Sure. So we know. Yes.
Yeah. Wait, we have what other?
Just a quick question before you move on. When you do audits, especially like quarterly, box up, what tax system do you guys use? Does your team use? Over at CSUN, you have the firm we call VITA, and as when like us business students, we volunteer our time, we do taxes for the community, and we use TaxSlayer. I've been doing that for about 2 years now. When you compile all this data, what system?
That's a great question. It's really more to do with what technology do we use? You would know that. Both of you should know.
So yeah, so we can two-part that. So we actually don't do tax anything. I actually have absolutely no idea anything involving taxes at all. So if you have questions on your deadline, don't come to me. I don't know. But because we do, and I think Raul will get into this in a little bit, but most of everything that we do, we don't follow GAAP. We don't follow standard accounting systems. It's all contractual. So everything that we look at is based on a contract. And that's why every single job is different. Every single participant's different, because the contract could have a slight tweak. Everything's different with that. But as far as like the technology we use, they're not going to know what it is.
No,
right?
it's post-COVID, I think one of the things that we had no choice but to do is work virtually using cloud-based technology. I think that may be the biggest, more significant change that we've experienced after COVID. All right. Yeah.
Do you work with EP partners or like payroll companies essentially, or is that you're just more of the consulting side of it, I guess?
Yeah.
Because of that, I think we have relationships with entertainment partners.
Okay.
And I usually go to them for advice. So if we come across an issue that I'm not really sure, I'll go to them because they're actually involved quite a bit with production tax credits around the world. I mean, I don't know if you've been involved in that, but I go, well, we have an auditing connection with a production that was made in Hungary. What do you know about production there? So they will give us that advice and support.
Okay.
Okay, let me just tell you a little. So I'm going to take you back in time well before I graduated, hopefully not. But the beginning of time for us in this business is actually, we've done some research that there's what we call the net deals and we've got the gross deals. The net deals are basically all the revenues less all the costs and whatever's left is shared. A gross is predominantly for the talent and they usually get shielded from the cost, but they get some percentage of the revenue. But if you really go back in time, the first deal that we can find was with the Belasco Production Company in 1923 with Warner Brothers, where they've entered into an actual back-end deal to bring Broadway shows onto the big screen. So they made films that were based on Broadway shows. And in there will be the net profit definition, there'll be a distribution fee, which we'll talk about later on, and most importantly for us, there were audit rights well before we were born, but almost 100 years ago. I think if you go to the next slide, the first gross deals that we can find are with John Barrymore and Al Jolson, and they're just different method of doing it, but the bottom line is it's been around for almost 100 years now. Yes.
Can you describe the difference between that deal and roast?
Yes, and I will have a slide on that, so I will get to it in 2 seconds. Thank you.
But it's, it's a teaser, so we wanted you to think about that question because it's coming. Go ahead. All right, I think it's you.
All right.
Go back this way.
So, what are profit participations? In a nutshell, it's a contractually agreed upon share of revenue or profit. One thing to kind of remember, and please remember this throughout the whole presentation, is that what we do is all contractual accounting. Like Heather said, everything's governed by the agreement that the participant or our client has with the studio. We don't follow GAAP. For those of you that know GAAP, that's like their rule book for publicly traded companies like Ford, Apple, and it's like a set of standards that they have to follow. But we do away with that. All we do is whatever the contract states. So who gets these type of deals? The talent. So you have your directors, your actors, your writers, producers, financiers like Legendary and Blumhouse, IP owners like authors of books that are being made into movies, video game companies as well, and even studios and agencies could also be getting these deals as well.
Can I interrupt? It's like also a piece to put on this is that because we don't follow GAAP or any sort of rules, we don't have to stay independent like most auditors do. So we actually, there's a moral code and we try to have this invisible wall if we have to do certain things. But, for example, we audit Lionsgate on behalf of participants, but then we also audit for Lionsgate when they want to review sub-distributors. So the people that we audit, the studios, also are our clients, and we kind of
Very confusing.
put our hands into multiple buckets. But we do try to have some sort of ethical wall most of the time. But yeah, we don't have to stay independent.
Yep. That's actually something I struggled with when I first joined the firm because, I had a public accounting background. There's a lot of rules, like you can't accept gifts from the whatever company you're auditing. And then when I came here and they're like, oh yeah, we also audit for them. And then, we're working with them to audit for our client. And I was just like, wait a minute, isn't it illegal? I'm not going to go to jail for doing this work, am I? So that's just something I kind of struggled with in the beginning just because of my background and, how I kind of learned, accounting and all that. But going to the deal types now, there's basically two major deal models. The first one is a traditional one. That's one where you kind of see bonuses, gross participations, net proceeds. This type of deal is, you really get paid out depending on how well the film or TV show is doing, right? If it's really doing well in theaters or it's really popular, you're probably gonna get a bigger piece of the pie on the back end. You also have your non-traditional model that's cost plus model. So that's something that's more popular with streaming platforms. So they'll pay out the participants the cost of whatever it costs to make the film plus a fixed fee. So the benefit with this is that you get a guaranteed paycheck, right? But the downside is that you don't really get anything long term. So if it's a huge hit show, you're not going to get any more money than the cost, whatever the deal was, the cost plus model. So cost to make it, and then plus a fixed fee. Yep. When they're deciding the bonuses, that's going in the contract before the release, and if so, are they going off their own projections, and those bonuses are based on their own projections?
It's typically a calculation, so it'll be like, and depending on who you are, you can negotiate better deals than, not everyone's going to have the exact same deal, but like, let's say you're a high A-level star, you can negotiate, at every, up until a certain point, let's say the box office makes like 25 million, you'll get $500,000. And then for every 10 million after that, you'll get another 500,000 or something like that. But that's why it's a calculation, because they don't know what it's going to hit. And, we've seen situations where they think it's going to be great and they're going to get all these bonuses, and then it ends up being a flop. And if it's based off of it's usually based off domestic box office, but they also have worldwide box office bonuses. So if it ends up flopping, then you don't get those bonuses.
So just to add to that really quick, I think you are onto something, that the production cost of the picture and the wide versus limited release is going to also drive the calculation of the bonus. So in other words, if it's a worldwide release, it's very likely, would you agree, that would be probably based on worldwide, and there are projections. As we all know, the studio has all the information that's putting together the film, and they do use projections which get updated continuously. So you're right. So there's actually there is a correlation between the likelihood of success and their anticipated bonuses and those tiers that Heather was referring to.
Yep.
If you guys ever feel like the workload is too much, you guys partner up with like Moss Adams or CBiz.
We're not going to give away our business to somebody else.
But what supplement studios were not going to them instead?
So we get hired. Yeah, we get hired by the talent. So the studios don't typically have they have a choice, but we're one of the pre-negotiated, because we're the biggest in the industry. We're one of the pre-negotiated allowable firms to do this. We're very close with all the studio teams. We know them very well, and most of our clients are repeat clients or referrals or anything, because we're the biggest. We talk to all the law firms. We work with them daily. So we'll get the referrals that come in. So they tend to hire us. Sure, they can always go with another firm. Usually it just comes down to if there's a conflict or someone else quoted us less. Money talk sometimes. So
I'm surprised you mentioned it, but I was going to say that we do have a resource need, and as a result, we merged one of our competitors into a firm.
Yeah, we bought one of our competitors actually. So
because it's such a specialized area, you can't just bring anybody. A guy has somebody with training, with understanding of the business. It's a little tricky just to get anybody into this role. I think it takes years to learn this business, right?
Yeah, and I guess to add a little bit to that, I came from another big four firm. It took me, I know when I started, Heather's like, hey, it's going to take you some time before you get caught up to speed on how we do things and what we do. And it did take a long time. And I'm surprised he chose me to come up here and talk to you guys. I'm still trying to figure some things out. But so it's not like any other firm could just come in and, do what we do. I think we just had a lot of knowledge in this field. And, when I, was interviewing with the firm, I was trying to find out more about profit participations. There's not a lot of resources out there.
I still remember Heather asking me, what are
gosh,
these?
do you love those stories?
I don't even understand.
It was like my first week here, and it was a complicated break-even statement. I'm like, I'm never gonna understand this. And he's like, yes, you will. Eventually, took a while. Took 2 years, but I finally got it.
Oh yeah.
The last one.
But yeah, just to finish up, why these deals matter. So contingent compensation on the studio side is kind of like one of their biggest liabilities on their books. And on the flip side, for the talent for our clients, it could be a significant stream of revenue, depending on the popularity of the film or TV show, it could be decades and they're still earning money off of that title.
Yeah. And what we do is very common. It's very a lot of times clients or studios or distributors or whatever will kind of build this into their ultimate investment model, because they just know there's going to be this continuous cash stream. So they're going to continue to want to audit and audit and audit, because stuff's just gonna be coming in.
All right, so these are some of the examples of the studios we work with. You have like your major ones: Disney, Fox, Sony, Warner Brothers. You have some that are a little bit smaller but still major players: Lionsgate, A24, and then you have your mini ones: Neon and Miramax. I work at Disney, Fox, Sony, and Warner, and I love working at Warner. Like Elon knows, because I get to go on the lot to review stuff. And so it's always cool, like walking around. Sometimes they're like baking stuff. I feel like sometimes I look like a celebrity because they're doing tours and they're trying to act like I'm somebody. But
Like, so
So I think it's important for us to say that this is the list as of today. With all the acquisitions, mergers, and spin-offs, that could look differently, in a year from now. And I think, right, we're getting used to the constant change in this business. I mean, Paramount, Warner, but I don't even know what it's going to be called. I mean, we'll have to wait and see.
I know. Yeah, Disney and Fox used to be on two separate lines, and now we have to combine
I
them.
know.
So it's constantly changing.
Parabros or something. I don't know.
Yeah.
So new media. So now it's not like just revenue. It's not just like box office and DVD sales. You got like digital exploitation of content, right? You have your TVOD, SVOD, AVOD, and EST.
All the VODs.
All the VODs.
There's a lot of VODs.
So TVOD is transactional video on demand. That's basically like, you're going on Amazon and renting Batman, and you get access to it for like 24 hours or 48 hours. You have SVOD, subscription video on demand. That's probably like the one we're all familiar with the most. Your Netflix, Hulu, Disney Plus. You're basically paying a fee every month to be able to access the content on their libraries. You have AVOD, advertiser supported video on demand. That's basically like Tubi, Peacock, for free with ads, and then Pluto TV. That's just free, but you got to sit through those ads. And then finally EST, electronic sell-through. That's basically you're just purchasing a digital copy of the movie or TV show.
Now, we just wanted to give you like a background of these because we're probably just going to use those acronyms throughout the rest of the presentation. It's okay if you don't remember what it is, but at least you have some sort of.
I just wanted to say,
Yeah.
the word SVOD, right? That subscription VOD that you mentioned, we see it, right? It is cannibalizing everything. It's killing everything to the left, to the right, behind and in front of it, because it's killing television. It's killing traditional home video. I mean, it's taking over in some cases theatrical because it goes straight to streaming. So I think that we have to recognize that subscription VOD has revolutionized our business in such a big way.
Whenever you're going to contact for a project, you see the balance sheet or the think or see like any of that stuff. Is that where you also see the subscription pop out of video on demand kind of
Pretty much, like you said, taking over the whole media scale.
Yeah, so we get copies of what we call so like the participants will get a statement, and we'll go into a little bit more detail, but every studio statement is fairly similar. Like they have a template that they kind of use, but each movie, each TV show, each participant, their statement could look a little bit differently, and it really is just like the world of data. And so that's where we see things broken up by market. So you'll have like your theatrical revenue, you'll have your SVOD revenue. If it's broken out, sometimes it's built into home video. Your TV revenue, your international, etc. Then you have your total revenues, you have all your expenses, your participation costs, your production costs, all of that stuff, and then whatever the share is they get at the bottom. So with that, we see it. If it's built into it, sure, we can't necessarily right off the bat say, hey, this is how much you have for SVOD, but when we get into an audit, we'll get a bunch of general ledgers, we'll get a bunch of detail that ties into those numbers, and then we can break it out by how much is for Netflix, how much is for Amazon, how much is for whatever it is. So yeah, we'll get that info kind of like through an audit.
Yeah, I just had a quick question. So does YouTube fall under ABOT?
Yes. Yes, it's not going to be as big as far as like the revenues that we see coming in, which is shocking because it's one of the biggest, I think it is the biggest like streamer.
No, I was going to say, it depends, right? So we have reality television
Right.
and late night shows.
That's
Who's watching
bigger on
SNL
YouTube.
anymore? Everybody's watching it on YouTube.
Yeah.
The next day. So what I'm saying is I think that it depends on so the programs that really are dramatically affected by YouTube will be reality and late night shows. But I think you're right. I mean, for the typical scripted program, you don't see a whole lot of great.
Yeah, if you have like a Spider-Man, like you're not gonna watch the movie on YouTube, and if you are, it's gonna be somebody that's illegally uploading it. It's not gonna be, you know, I don't even know what studio that is. Whatever studio that is. Sony, thank you. Clearly I don't work at Sony. You know, Sony's not gonna be the one getting money from that. So they won't actually show on the statement.
Can a service be considered under two categories? Like Amazon, for instance, they have their Prime subscription as well as their, you know, rent Batman.
Yep.
Okay.
So the transactional Amazon will fall under a different category, and then the like Prime SVOD service will fall under a different category. And then
Although, wait, they're tricking you though. You're still paying, I think, because you're paying for the right. There's
on their end,
lower
but from
level-
our perspective,
no,
yes.
on the lower level, you're still paying for the the unlimited shipping, which gives you the access to the advertising supported. Okay, it's a trick.
Right.
See,
No, you're right.
Yeah. Even on the A-Bot statement this brother had, in terms of YouTube, I mean, I've seen it on my own YouTube. Like, I can watch movies on there for like free with ads. Like, I think I watched Takers the other night. This little heist movie on YouTube, but that was free with ads. Like, so what does that do? Are like YouTube is
So yeah, so if it's if it's like the studio or the distributor that's releasing it with that, they'll pay that. Because you're probably not going to get as many viewers as you would as like a Netflix. You're not going to pay as much as like a Netflix would, but revenue will still come in from that. So it can exist. It's just not as common.
I was going to say more likely than not, the way it works is the studio will say, we're going to license to you YouTube for a fee. There's actually a fixed amount. And then you can share it with your audience. You can keep your advertising. I think we're moving away from sharing of the advertising. I think it's more now a license agreement. Yeah.
And I guess, yeah, I'm just curious about that YouTube one because that's where we're going, right? The Academy is getting ready to be presented on YouTube. So I think with all these like independent projects, everybody's going to be placing their projects on YouTube. So if there's a licensing fee in that, that's why I was just kind of curious of like, are we walking in that direction and where would that land?
Yeah, I mean, YouTube will still pay out ad revenue, especially if you see ads. There's going to be ad revenue. So depending on if you're releasing it on YouTube specifically to have a YouTube release, you're probably going to have a different negotiated contract with them to get whatever share, if at all, of the, or like what percentage of the share that you're getting of their ad revenue. But if you're doing it through like a major studio, that's going to be more of like the fee.
Yeah, I was going to say, Sharon, the sad thing about it is if you're relying on the advertising share, it's kind of like Spotify. You're not making a whole lot of money. Right. It's actually the placement. So if you have a channel and you're bringing in product that you're promoting, that's where you make the money, not so much the advertising share, unless you have like million hits. Like if you're going to have like, there's a scale where you start making money. But if it's like 100,000 people watching you, the point is that the economics of YouTube is still not clear. And I think that's really we'll have to wait and see. But the reason why reality television makes a big difference is because you got massive number of people hitting those links. You don't get that much, I think, otherwise. But I think it's really the placements. If you're going to promote a product, then you're going to get a whole lot of money. All right.
Oh, yeah.
Quick question. When you guys audit a studio on behalf of the talent and you all do find money owed, I heard you mention litigation. Do you all work with like a team of attorneys that actually collect the money for the clients? How do you all
I have a
work?
great question to you. But you want to try it?
Sure. So 99% of our jobs we hope don't go to litigation. So we'll do it during a normal audit process. Where we have those settlement calls with the studio and they'll either settle in the background or there'll be mediation or something like that. But for the 1% or 2% that do end up going to litigation, we do have close, contacts that are litigators that we work with all the time. A lot of times we work with them anyway, because even if it doesn't end up going, a lot of times clients will threaten litigation if they really want to get their way with the studio or whatever it is. So we connect them with our litigation contacts and they'll go through that. And then we have done litigation support work for them. So, if they need to come back to us and do the actual calculations or valuations on the back end, we'll do that as well. But it doesn't, it's more rare than not.
But those that are rare could become big. And
Yeah.
we actually have two examples where two of our audits became major litigation cases that were all of use. So we'll get to that.
So you're like creative accounting PI.
Using creativity.
Yeah, I'm gonna put that on my
We
LinkedIn.
have to be creative to find those creative issues.
Okay, and we can like briefly kind of go through this. Most of you kind of know how it works, but just a little bit more of a background of the typical film release window. You know, let's say, and again, this is for a film, so it's initially released theatrically, and then I would say
A month.
yeah, maybe like a month or so is typically in there. And we're talking about an ideal world. We're, you know, not a COVID world where everything was kind of a little flipped, turned upside down. But, you know, then it'll go more into like it could go into a PVOD situation, which that is premium. Sometimes that's like a day and date release where you're going to pay, like, let's say you pay Disney Plus like $25 or whatever it costs, and you get to watch the movie that's also being released in theaters. You don't actually have to go to the movie theater. You can watch it at home on Disney Plus, but you're going to pay a premium for that. And then after that, it goes into the home video markets. You're going to have the chance to buy it on like through Apple, through your iTunes, physical media, which is obviously dying, but you have the chance to do that. And then it'll go into like a pay TV platform, which is going to be your streamer for like a Showtime and HBO, something like that. Then we go to another pay TV window. Then it'll end up on free TV, where your normal cable channels, and then you'll get into library titles, your AVODs, and things like that. So the most money makers are towards the beginning of the film release windows. You're going to get your most money theatrically on a statement. Then you'll get home video money, and then you'll get your Netflix fees, etc., pay TV, and kind of go down from there. Okay, so a little bit more details on a gross deal versus a net deal. So like I think Alon brought it up before, but the gross deal is really the most ideal situation you can be in. We don't see it a lot anymore. It still can happen, but it's a little bit more rare because I think the studios realized they're not making as much on it. So this is your deal where you're basically just getting a percentage of the revenue. Now the studio gets to recoup their what we call off the top costs. So like the taxes, the guilds, like stuff that actually has to go and get paid out to a third party, no matter how successful the movie is. They get to recoup those. And then at the end of that, whatever's left over, you get a share of it. So 10%, 12%, 1%, depends on whatever your lawyers negotiate for you. So that's the most ideal. That's where you're going to get the most money. Now, the most common are these net deals. And that's where, like the statement I was describing earlier, we start with all the revenue. Now the studio's taking a distribution fee. So it could be anywhere from 10 to 35%. I've seen it. 40% I've seen it. Rarer. It's usually about 10 to 12%. So the studio gets to keep that little distribution fee, which is a percentage of the revenues. And then they'll deduct every single cost under the sun. So all your advertising costs, all your print costs, your duplication, your guild, your taxes, anything that went into making this movie. And then after that, they're deducting all the production costs. So if it's a $100 million production movie, they'll deduct that. They could deduct an admin fee on the production costs. They can deduct all the participations that go out to other people. They'll deduct interest on the production costs. What else is there? Though I feel like there's more, but anything that they could ever deduct, they're deducting from them. And then after that, you get your 1%, 10%, 12%, whatever your percentage share is. So your pot is a lot smaller. And typically with these, we also see more, you're not getting a pure, like on the revenue side, you're not getting a pure 100% of your revenues. You know, a lot of studios will only give you 20% value for home video, for example. So we deal with a lot of royalties as well. So you think you think there's $50 million in home video revenue, you're only getting 20% of that. And then you're still getting a share at the bottom on top of them already taking and keeping 80% of it.
I think what Heather's
So it's a
saying
lot.
is they don't want you to make any money.
Right. They want these to not.
It's a lot of obstacles to get to
Yeah.
the money.
Yes. Okay.
My mind is kind of blown by that. So you're taking distribution deal, like a distribution fee, and then they're taking, see, guys, what was the distribution?
Correct.
You have the privilege of us distributing this film for you. What's it gonna charge you for?
Pretty much. So it's a cost to cover their like internal, supposed to cover their internal salaries. You know, their rent for their lease on their building, or they're paying their employees to work on this job and to work on the distribution and to do all that stuff. So that's kind of their pre-negotiated share of money they get to keep. And again, all of this is, I don't want to say it's fake money because it's not fake money, but it's not like a real, when you think of like a balance sheet where everything kind of like is money going in, money going out, it's all real. It's all real, but the way that the agreements or the contracts are kind of manipulated, it creates this like fake picture of what is actually allowed to go to you. You know, it's not like, well, again, just because this made $50 million doesn't mean that's what you're getting paid, because we have all these numbers that break it down.
When you say you, who am I?
The participant, the talent. So imagine for all of this, you guys are directors. That's gonna be the you.
All right, thank you. Because I noticed that there's a lot of popular aspects now where actors are now the executive producers, and they are a big chunk of that on top of.
Well,
Yeah.
they get more money.
Yeah. Well,
They could have two different deals. So you get an executive producer statement, you can get a directing statement, a acting statement. You can get multiple statements. They may look the same. They typically don't. So there's typically like a couple definitions that change. So maybe like the acting statement, you get 20% royalty in this fee, but then like on your directing statement, it's going to be a little bit more lucrative, and they'll wipe away admin fees or something. So depending on probably where you spend the more time, and depending on who you are and what your name is, you'll get a little bit of a different payout, but you could potentially make from two different statements.
Oh, okay.
Yeah, all from the same bucket of money. That's what I meant by like it's one bucket of money, but they're paying out different ways.
And all of them are kind of relatively small numbers, no more than like maybe 1 or 2% based on these type of things, just because there's so much to a pie. So.
You can, it's, I think depending on how many participants are on it too, you can get like your 5%, your 10%. Financiers typically have way higher, so they're like the 25-50% because they're putting more money into the movie. So their deals do look a little bit different. So everything I'm saying to you now is kind of just assuming it's more of the talent side.
Sure.
But they will typically get higher shares. But yeah, I would say 1 to 12.5. Sometimes I've seen 25, but it's top talent rare, you know, that they'll get that high. Yeah.
Let's say I accidentally commit fraud by accident.
By accident, 100%.
Yeah, in the sense, like you misreport a loss, but not you report part of a loss, but then you remember, there's some other portions that I didn't report later on.
Are you talking about from a studio's perspective, or okay?
Inflating revenue could be fake or whatever.
Mm-hmm. That's where we come in to find that. Also with fraud, you have to prove intent. So we try not to use those words with the studio. We don't want to say they're committing fraud. It's just that the money was in the wrong bucket, or like that's what we go through our forensic review and make sure all the revenue that's supposed to be there is there, and all the expenses that are not supposed to be there that we can take out.
Yeah, I was going to give you an example without sharing any detail. It's who and what and when. But there was a division at one of the studios that looked at our findings and noticed that there's a trending that there seems to be a bunch of significant miscodes. In other words, costs were allocated to the picture we're auditing that really belongs to other pictures. Like we're trying to figure out why so much cost is moving into the pictures we're auditing, which typically are the successful titles. Mm-hmm. So the pictures that succeed are more likely to be audited, and what we're finding, costs from a bunch of, I hate to use the word, but I'm going to use it, loser titles are being pushed into this picture. But they've noticed that there was a trend, and they investigated that, and it turns out that the division head was shifting money around in order to show net profits for the division. So in other words, if I think about that, if I push more of the cost to a successful picture, what will happen is you'll pay less participations, you'll pay less share of the net profits, and as a result, the division makes more money, and as a result, they make
They get their bonus.
higher bonus.
Yeah.
No, but they found it. They've terminated the people who were responsible. So in other words, we don't really focus on intent, but our findings actually could be further investigated.
Is marketing taken account in this as well or no?
Marketing costs?
Yeah, marketing
Yeah,
costs.
yeah.
Okay.
So like marketing and advertising, that's all kind of lumped together and
Oh, it is.
one part, all the P&A and all of that. Yeah.
What's like the do you know like the average number of the marketing costs from like typical production from your end? What you're just kind of seeing as a pattern?
At least 50% of the production.
Okay, yeah, I figured that was.
It's a lot. I mean, depending on the film, it could be a lot, but average, I don't know. Like, I'm gonna ask this guy.
It's about half, at least half of the production. So if it's $100 million in production costs, it's very likely they're going to spend at least $50 million in marketing. I think there was a question mark here.
For talent with a net deal, do they still get a flat rate before this, or is the net deal just on top of that?
Yeah. I mean, I'd say on average, yes. This is just the contingent compensation piece. So typically they'll get like their flat fee for doing the movie. You know, like, oh, you made $500,000, $1 million flat fee at the beginning, and then you get a percentage of. That's kind of what we look at. You get a percentage of the back end based on the success of the title.
Yeah, they could get like their director fees or something like that, and then maybe some bonuses, and then the contingent comp is like at the end. Right.
Yeah.
And then in addition, hockey with possible bonuses
Like
after the.
yeah, like more like residual kind of royalties. They'll get paid on that, but that's all kind of comes out of like a separate.
Yeah, I mean, I think most of the time it will be television related. So if you have a television series that's made and you're going to get contingent compensation, which is always on a net basis in television, but you're also going to get bonuses. You're going to get also royalty. In some cases, producers get royalty per episode made. So as they make more money. So there's actually, and it's not, by the way, it's not recoupable against it's just more money they get.
I have a question since we're talking about that. Are you guys familiar with the Tom Cruise's do like for Maverick? I think he took like 12 million up front, which you typically can take about like 50 million to 100, and then I think it was like some parts.
And then he negotiates for a percentage on the bigger percentage of.
Yeah, I mean, I think we've talked about that. We're under confidentiality with any of these projects. We get to
I'm talking generalities.
But we actually do work with some of the top talent in Hollywood. That amount that's received very likely is recoupable against contingent comp. So in other words, you're not going to get it twice. It's going to be, you said 12 million?
I think you take about roughly around like 12.
Let's say, whatever it is. That is effectively an advance against the waterfall. So you're not going to get it twice, most likely. You're going to get it up front, and then you're going to be recouping that against the success of the film. And then once you exceed that, then you start making more money.
So the 12 is at least like you're guaranteed to get 12. If the
Literally
movie
guaranteed.
completely bombs, at least you got $12 million, but you can get above and beyond that if it does very well.
And then the participation on the back end is if the movie does well.
If it does well and it recoups that amount and everything above and beyond that, yeah, he'll get paid out on.
Question: you mentioned something about the financiers, and also percentage. I wasn't aware of this. Do they always take a mid deal, or I mean, obviously it's negotiated, but I always, for some reason, thought they always got gross.
Yeah,
I told you net.
they could, but yes, more often than not, that's what I was saying. Like this is more for talent. More often than not, they're taking what's closer to kind of a gross deal. Maybe no distribution fees, just more of a revenue off the top deals or expenses, and then taking a fee on that and recouping their costs and all of that stuff.
And I was just going to add, I think what we see, it's a good question, that there's what we call a gross corridor. So what will happen is they may be getting a net, they're going to get gross participation up until the point that the studio is recouped. And then it's going to stop and it's going to switch over to the net. And again, the gross participation they received as a corridor will be, again, advanced against the net. So what it is, it's basically they're going to earn some money up front, but then that will be an advance against the net. It's called a gross corridor. It's really interesting. I mean, it gets so complicated. We don't want to confuse all of you.
You want to talk about?
Oh my gosh. Okay. So I'm looking at the time. I want to make sure that we have enough time to go through all the slides, but I'm just going to. this is what World was talking about. The word accounting probably doesn't belong because it's not. But Hollywood accounting, if you've heard that term before, what it really means, those of you who are accountants have taken accounting classes, there is no such thing as a matching principle. What normally you'll find is revenue is reportable when it's earned and collected, right? Which means it's going to take a while before you're going to see the revenue coming in. But the cost is usually charged early.
Right when they do it.
Early.
Yeah.
When it's accrued, when it's, when you get the invoice, not when it's paid. So what happens is just the most important concept is revenue always chases the cost. The cost is always ahead of it, and you always try to get close to it, especially on the television side, because you produce and then you get the money. You produce and then you get it, and you keep chasing and you go, am I ever going to see a dime? But it's always that way. I'm not going to throw all the examples, but I just want to make sure you recognize that as a matching principle is a big one. The other one, the related party and self-dealing, that is the number one issue we see today. What does that mean? Vertical integration. Basically, I own everything. I have the production under my control. I have the distribution under my control. I have the network under my control, which means I control everything. So what I could do is I can make deals with myself in a way that benefits me and my shareholders, but not necessarily benefits the production company, the talent. And I think what our job is to find that right balance of, wait a minute, you should have given value to this deal much, much higher than you've given. Because what happens as a result of them underreporting, our client, which is the talent or the production company, will see less revenue, and we're trying to push the revenue up, and that's the issue.
Yeah. Is it often that they're under the fair market value? Do you often find that?
I think for me, it's 50-50. I see in some cases it's right on or a little bit higher, but only because it's lower.
Yeah, and we try to use like comparisons to third party licenses and stuff like that to compare, and we've seen it goes either way, honestly, like half the time. Yeah.
Great question. And that's it.
Okay, so it looks scary, but it's not, I swear. So here's kind of like what I was talking about, just a very, very high overview of what a statement could potentially look like. It gets way more complicated than this, but I didn't want to scare everybody because I swear what we do is fun. But this is just kind of to show you how you could have one participant, so participant A and participant B on the exact same movie at the exact same time, but they just haven't negotiated a different deal. So you're dealing with the same pot of money. You can see the total gross receipts on participant A is 127 million because they're getting everything reported at 100%. But then when home video is then reduced down to this 20% royalty, now instead of 25 million, participant B is only getting $5 million of that total pot. So it brings down their gross receipts a lot more. And then the studio's taking a distribution fee. For sake of this example, they're taking the same distribution fee. Typically, they don't take a distribution fee on the royalty revenue, because otherwise we would argue, hey, you're already keeping 80%. Why do you get to keep another 20% of that 80%? So I think this math actually is excluding the home video. And then we have our distribution costs. Again, very similar, but let's say participant B didn't have a great deal. So now there's a 10% fee of the advertising cost that the studio also gets to keep. And then down to negative costs, which is your cost of production. Also, has anyone heard negative costs before? Okay, one person, great. Because when I first started here, this threw me the hell off and I didn't understand anything about it because it sounds like a negative and I didn't get that. So it's actually, what does it come from back in the day, like the actual cost of a negative of a movie? And that's the cost of production and that's everything there. So I was like, someone's not going to know what this is, and that's very fair. And so yeah, the studio takes 10% of their fee on that, and then accordingly, because the overhead is higher, the interest is then also higher. And so you can see with the exact same pot of money and on the same movie, participant A made $14 million before their share, and participant B is in the whole $12 million. So there needs to be at least $40 million of more revenue before they can even break even to start getting paid out.
Is it fair to say that participant A had more leverage?
Correct.
Be a better
Typically,
lawyer,
yes.
better agent?
Either a better lawyer
More money?
or a bigger name. You know, you could be the top billed cast of a movie versus like a little bit of a smaller, not quite Joe Schmo, but like the smaller end, like maybe like the C level, D level actor is gonna get a much worse deal. Any questions on that before I move on?
Okay. So I don't want to spend too much time on this slide, but I think we've said much of it, but I wanted to highlight there's a crazy thing on the right, but the bottom line is, in fact, this is a few months old.
And so
Just under 50% of the eyeballs are on new media. It's all streaming now. This was at a time, this is only 6 months old.
it's 2 years old.
Is it?
Yeah, I couldn't find an update. That's my bad.
Sorry.
Sorry.
No, that's fine. 2 years ago, a year and a half ago, I think, actually, it was under 40%, but now it's actually just about a 50%. So traditional media only represents 50% of the viewership now. That's how crazy it is. And it affects everything that we do because everything is moving into that world. We have to look at streaming deals. We have to look at if it's fair and reasonable, if it's a streaming deal that's owned by the studio, there's a related party concerns, and we look at that. So the key is it's a different world today than it was even just 5 years ago. I think that's all I wanted to say. I think this one. Okay. So this is for anybody here is an evaluation geek in this room. Okay. So what we did, and I think this is actually, I'm proud of what we've done. It was a lot of work. We have taken every audit we've done and moved it into like a black box and then mixed it all up. No one knows where it's coming from and came up with trends. And we can now project how much a film will make depending on when it was made, by whom, and what genre, even just to that level. And all we wanted to share with you is an example. And the example is showing that what will happen to $1 that goes into the theater. So you pay to see a movie downstream. What happens to that $1? So I'm going to use the example on the far right, which is for films that were made and released post 2017. You're going to get 48% of that dollar, 48 cents of that dollar, again, paid for the theater, will end up on your statement. So it's just about half of the theatrical box office will end up on the statement. And then the next, and this goes back to your presentation, and the next stage will be traditional video, which is about 24 cents. After that, we have transactional VOD, which is about 17 cents. And it goes on and on. I think the one that jumps up is television, which includes, by the way, streaming. But the most important point I think this chart gives you is, again, it's what will happen, the ultimates. What will happen to the revenue downstream if it's a film that was made post 2017? I don't know if you can add that, but the bottom line is as films are released further and further into the future, are making less money. So what happens now, $1 is generating, the $1 that goes into the theaters is generating less and less and less for newer and newer films. So a lot of producers are struggling now because there's less and less money in the pie. And why? Because SVOD is killing everything else. So it's killing, so you've got Netflix, but then you're not gonna have all those regional television stations in Europe that are gonna buy from you. But Netflix is not gonna pay you enough to cover all of those opportunity losses that you could have sold to. That's really the message here. And the other slide, really quickly, so we do a film study and we do a television study, and just to share with you some of our more recent study on the television side, without getting into numbers, here's what we see. There's increased competition. Lots and lots of streamers are competing for the same talent, the same production companies. In fact, it's still, finding the talent is still a struggle, so it's competitive still. There's increased pressure, though, on the streamers to make money, right? They can't just not make money anymore, what happens now? They are spending less and less money on production. because they have to think of the cash flow, they have to think of their profit. So there is increased pressure on those streamers making shows, or indirectly on other companies making shows for the streamers. What we're finding, which is really fascinating, the talent is still making, the very few really successful people that make or participate in television, the showrunners, the top talent actually performs, they are getting better deals, surprisingly. And then finally, what really shocked us is production costs and distribution costs are ballooning. There's just so much more cost in television. It's unbelievable. It used to cost maybe $2 million an episode, maybe, to make. Now it's somewhere between $7 to $10 million an episode. It's just insane how expensive it is to make them. And then to market them is another step, because it's so, it's just a crowded market. It's hard to find the program that might be a good one to watch. They're spending the money to get to you. So that's all the things I wanted to share. So I don't know if,
I have a question.
yeah.
Yeah, there's a question that you mentioned, like how the big payers are they make sure they're trying to drive down costs and maximize efficiency. In this case, do you see that like home video on demand offices and all that stuff are just going to keep marketing their old stuff instead of investing more into our new stuff?
Yeah, this is a great point you're bringing up. So what we're noticing now, they're making less new programs and they're licensing in a lot more. Why? Because it doesn't cost a whole lot. It's just, you just pay the license fee. There's no production cost. There's no marketing. It's because a lot of these are relatively known brands. I mean, I'm thinking of a good show like Suits was on Netflix for a period of time. It's off now, but Suits was a known entity. It's not as hard to promote that. So marketing costs are lower.
We can quickly.
All right, so now we could talk about our audit and settlement process. I guess I'll use the mic, otherwise it can't be funny. So again, the audit must be done in accordance with the agreement. The agreement that the participant has with the studio, again, dictates everything: tolling dates, notices, timing of audits, and then types of audits. We obviously have film and TV series, successive film and TV series, legacy projects that have seen new life through the streaming. So sometimes you'll have like an old show that it kind of blows up in popularity again, and it's on like your Netflix or HBO Max, and then people are watching it for nostalgia or something. And then we also do video game audits. I think Elon did one, consultations and ultimates.
Well, I just want to, for you to the next one, I want to talk about kind of also the concept of tolling really quickly. So that's like one of the main not worries, but like things that kind of we have to deal with at the beginning of a job. So tolling date is really the date that the studio gives the talent or whoever has a back-end deal in order to bring objections to the statement. So the very first one is in the agreement. Everything is based on, like we said, everything's based on the agreement. So the first one is like, okay, you have about 12 to 48 months, depending on the contract, to let us know that you object to the statement that you got, that we mailed to you, and bring, get yourself in the queue and bring forth an audit. Once that happens, and once they put in their notice and they're in the queue, which I'll just hit the next one. So the queues are different depending on the studio. A studio like Fox or Disney that's much bigger is it's gonna be 5 years before we could probably get to a title. But like smaller distributors who don't really have a lot of titles, there's not as much going on. We may start tomorrow, or we may start in 6 months. It's gonna be a little bit faster. But so once they put in that notice, then the studio authorizes them, okay, now you have a new date, and this is the date that you have to commence. And then once we commence the audit, now you have a new date, and this is the date you have to submit your audit report. And then once we submit the audit report, they're like, okay, now you have until this date to bring forth litigation if you want to. And a lot of studios, as long as you request an extension, they'll happily oblige, as long as they can kind of tell that the audit's moving. Some studios are a little bit more strict, and if you are even in past midnight on the next day when you send a notice, they're like, nope, you can't audit the first statement. So now you have to go to the next statement, which means if it's in a case of an inception deal, you missed out on all your theatrical revenue, You missed out on all your production costs. Anything that came out at the very beginning of the cycle of the film, we would completely miss out the option to even look at that detail, and we would start from whenever the next statement would start. So that's our thorn in our side a lot of the times too.
Yeah, and some of these audits could take a couple months, 6 months to 18 months. I think the quickest audit that I've been on was like maybe 4 months or something like that. I loved it. And then some of the audits that I worked on when I started at the firm. And, years later, 3 years later, it's like, all right, we're wrapping.
We're gonna work on when I started at the firm. So there's some that take 5, 6, 7 years.
Yep, question.
Is there any regulation on the process, like this statute of limitations on when they can bring this forward, or is it just like you're at the mercy of whatever your contract is?
There you go. Yeah, you're basically at the mercy of whatever your contract is with the studio. That's it. There's no like governing body. There's no regulatory force, nothing like that. It's just the contract, and that's like the ominous.
I was gonna say, unless you litigate. Everything's open then.
Yeah, but
Let's make sure, I know that some of you may be leaving in about 10 or 15 minutes. So my only ask is, how many more slides do we have?
10, but we can. The
What I was
other
gonna
ones
say,
are very quick
Are you
ones.
sure? I just wanna make sure if there's any slides that you wanna make sure we bring up.
Here we can. You could just quickly talk about that, and then we'll get.
And then we'll take questions. I just wanna make sure we hit through a couple more slides. That's okay, because I know I'm losing one class in about 15 minutes.
Yeah, so I could go over some of the claims we make, and this is kind of where we generate value for our clients. Like this first type of claim, errors and contract non-compliance claim. That's like a pretty simple one to follow. Say you're reviewing the expenses being charged to the film or TV show, and you see this expense for another film or TV that has nothing to do with the title you're auditing. That's a simple miscode. You could kind of raise it and say, hey, why are you guys charging this expense from this other TV show onto this TV show? Deviations from profit definition. What is that, Heather? That's
So typically studios will have their standard definition that's just like a plug and play that they give to everybody. And then depending on negotiation, a talent or somebody will have a writer or an amendment that will kind of modify parts of the standard agreement. So instead of, the 35% distribution fee, which is standard, now you will only charge you 10%. You negotiated to have a better deal or like a higher home video royalty. And so those are typically the places we find the claims, because a lot of the statement prep on the studio side is a manual process. So somebody that's sitting there doing the statement could have missed a writer, could have missed an amendment, and so they're charging the wrong fee or not giving the proper royalty.
Yeah, you also got your contractual interpretation claims, like the big one that Alon had mentioned earlier was related party. Of course, you have the vertical integration, which is, a big deal in like regular accounting GAAP. Like if you own a company and you're doing business with another company you own, it's like, wait a minute, are you hooking yourself up? In our world, obviously there's no regulatory agency, but we also kind of ask the question like, hey, was this license fairly priced? Like, you're licensing it on your own streaming platform. If you were to do it with a third party, what value would you assign to it? And sometimes we could generate, a lot of money with that claim, and it's always nice when you get the talent some big money, so it feels good, even though you're like,
Maybe rich people richer.
Yeah.
That's not
you're
nothing.
kind of second guessing yourself after a while. And you also got your equity claims and your open item claims. Open items is pretty easy. Like, you ask to look at an agreement or an expense, and in the studio it just doesn't give you anything. You can't really say, oh, well, you like that expense, it was $50,000. Like you have nothing to kind of look at. So you just kind of raise what's called a non-quantifiable claim. And, I think studios are pretty understanding of that. Sometimes they're not going to have everything on hand for you.
Yeah, they might just kind of throw money into the pot at the end of it. So we don't really assign a value to it, but they're like, all right, well, we didn't give you support for like $1 million. Here's $20K or something just to kind of get you to get over it, sort of thing. And then there's equity too, which is more like, it's not necessarily per the agreement, but is it fair? Does it follow kind of industry standard? Does it follow like the intent of the agreement, or what you kind of thought that this situation should be, but it's not necessarily laid out in the agreement.
Yeah, like a quick example, I think Heather touched on it. Like if you're getting home video at a royalty at 20%, but then they're still charging expenses for home video at 100%, you know, are you really getting 20% of the revenue? Like, because when you take into account the expenses that you're also taking on, like you're not really getting that 20%. So that's the type of claim that's, you know, equity claim.
Yeah. Okay.
How you gonna maintain relationships with both types of clients, like the talent in the studio, without being the conflict of interest? I guess that's pretty like the elephant in the room, right?
Yeah, well, because like I said, this is just a normal part of business. They're used to it. There's entire teams on the studio dedicated to this. This is their entire job. If there was no one to audit, they'd be out of a job. So I think they're kind of, you know, happy-ish that this exists, but that's their, you know, go ahead.
No. But I was going to ask you. I mean, are there instances where I think you and I have had to deal with that where you and I were working for and against the same entity? Remember, like I think you could.
It was the Lions Day one.
I know. It's like you're
Yeah.
like, wait.
Well, and I had
How do I
to
work
kind
through
of
that?
drop off that one because I'm like, well, I audit you, and now I'm working for you. I'm gonna go ahead and step off this one. We have other people on our team, like Raul can handle that. You know, like other people that are kind of there can handle it. And you know, that's not to say there is never animosity with the studios. We do deal with some aggressive personalities sometimes. Some are nicer than others. But you know, they at the end of the day, they know that this is the normal course of what's going
So I was going to say, we are an accounting firm. We have to follow the Board of Accountancy's guidelines and requirements to be licensed to be a CPA firm, and they follow the AICPA rules. Therefore, we follow wherever they're going. And as a forensic accountant, I must maintain objectivity and professionalism. So, regardless of who I work for. But the one thing that we need to do is we need to, per the AICPA, we have to be transparent and say to the party, look, we're auditing. If somebody comes to us and says, we'd like you to audit party B, we need to tell the client, look, we actually are working on their behalf, just so you're aware. As long as there is awareness and no issue, there's no problem. But there are companies that would say, we have instances where we don't mind if you audit us because there's just only so many people that can do audits, but those who are working for us cannot be the same team that's auditing against us. So we work out the conflicts.
And every once in a while we could be conflicted out, and then we will send it to maybe somebody else and be like, hey, we have a complete conflict. We're not allowed to touch an audit of this. You know, here's another firm that we recommend. So we have and can do that. Yeah.
There's tons of blends here. What is the most common one we run into?
It depends on the studio, honestly. There's a lot of studios where their books are pretty clean, and so we're not going to find a lot of the pure reconciliation errors. We're not going to find a lot of miscodes. So we kind of have to get creative with it. You know, our job is to look at the agreement and find those gray areas where we can argue like, okay, well, maybe it says this, but we can interpret it this way a little bit. We can get a little creative with it. I think you mentioned the other day, sometimes it also comes down to like a comma placement. You know, if a comma is placed in a certain area, we're going to interpret this side of the comma as one definition. The studio is going to interpret it as this definition, and that's where we argue and hopefully some meet in the middle somehow.
So let's go.
Yeah.
All your questions, like I want to see. Do we have?
It's just the samples.
The
It's just a
litigation,
couple, yeah.
right? Okay, we want to close with the litigation just before you all, because that's the fun ones.
You
Do you have a question?
Get the question. Grace.
No, I'll hold it.
Oh, okay, good.
No worries.
All right, so why don't we just go through? I think it's fun just to kind of go.
Let's just do this one and the next one, and we should grab on.
All right. Yeah, so for this one, Scarlett Johansson alleged that her contract for Black Widow included bonuses that tied to theatrical box office performance, and that Disney, I think at the time, due to COVID, they delayed the release of Black Widow and then decided to release it both theatrically and on Disney Plus at the same time, thereby reducing her bonus earnings, right? Like, you know, she might be thinking like, well, if you could watch it on Disney Plus, why would you go to the movie theaters? So she claimed that Disney's decision to do that, releasing it on their own streaming service, simultaneously affected her back-end compensation. The case was
She's right. It did.
The case was eventually settled in late 2021. But why it matters is because it's kind of illustrating the shift from streaming to hybrid release. So like older contracts are kind of showing their age because they're more tied to theatrical box office performance than take into account that some places are going to be releasing it, through on their streaming services as well. And it kind of signals to the talent that there needs to be a little bit more transparency over streaming revenue because it's becoming increasingly important.
And there were also some studios who, I'm pretty sure, this is public knowledge. I checked myself for a second. There were some studios, because this happened to a lot of studios over COVID. Everything shut down. Of course, people are going to see stuff from their house because they can't go out. Theaters are closed. There were some studios that recognized this and then proactively went and negotiated with their talent to give them some sort of compensation to make up for the fact that there was going to be no theatrical revenue. Not every studio did it. Some studio had to wait until an audit or until it was litigated. Others proactively did it just to kind of show, hey, in good faith, we recognize we had to shut this down, but we still should owe you some money because we made a buttload of money releasing this, via PVOD or whatnot.
So the source with Tropic Education was more box office based. Now that streaming is more subscriber based, and are you determining the long term value of film or series when it comes to compensating their talents?
Amazing question. We don't necessarily know all the intricacies of it yet. It's a constant battle in this industry because, as you know, Netflix doesn't release their subscriber information, so we can't, with that as an example, we can't really see that. So we're kind of, there's teams of that, we're not valuation experts. There's teams of valuation experts out there that are constantly working behind the scenes that are both third party and actually work for the studio, that are constantly trying to find market value, trying to see, what third parties are willing to pay and what the demand is and stuff like that, and working some sort of financial model to do that. We don't really get that access on the back end. We just kind of see, we kind of have to do more of a high level, okay, well, a third party paid you this, you're doing this is kind of what the comps are, and just go from there. Yeah, but they're kind of doing their own thing in the background to see what the fair market value of that is. I think this is the last one.
Okay, so that may be the last slide, but we want to, I know we're 5 more minutes, but we'll be here a little bit after, so those of you who are here, ask us
Bones?
anything.
This is the big one.
Bones, okay. So this is an audit that I think I started back in 2012.
And now I'm on it. So
The first time,
it's
I don't know that
taken a
really
while.
well. But the most important point about the Bones case is it was really interesting about this case. It evolved as a result of our audit. Remember you were talking about what does it go into litigation? And we've come across a bunch of different issues across multiple different media, and there were significant, this is a long standing television series, I think it was 12 seasons long. And based on the findings of the audit, based on the findings of our work, the transactional attorneys that represent the talent or the production companies came together and it made a decision that there's enough here that makes it financially viable to pursue at least a conversation with the litigator. It led to a litigation that went through arbitration. Didn't go so well because Disney, which at that point acquired 20th Century Fox, appealed. And what happens when you appeal, the arbitration, which is subject to confidentiality, suddenly opens up. So you can actually all of you can go online and read the decision by the arbitrator, which was very explicit about how he felt about the executives of.
He was off happy with the studio, basically.
Right. Anyway, there was so they went to the appeals court, which reversed a portion of the decision of the arbitrator that was more punitive. The punitive portion was eliminated. All of the clients that went with that, I think 2 litigators were representing them, were about to go and appeal that decision. So they were going to go forward at that moment in time. And by the way, no one knows either. Certainly not us.
We don't know.
It got settled. Now, but just to give you an idea of the length of time that we're dealing with here is, I think we started the audit process in 2010. This was settled in 2019. So it takes about 9 years, really, almost 10 years to get from the point of inception all the way to the settlement. So it's a long, long process. And the only other thing I was going to add is everything around this is all about related parties. This is all about related party issues. And that was the essence of the case. That was the essence of our claims that led to the litigation. So
Yeah, that basically 20th Century Fox didn't give enough, like what we were saying before, they didn't give enough value to their own platforms that a third party would have given. And actually, like, so funny story, the guy that worked for Fox, there was a contract between Fox and Hulu, and the same guy signed for both sides because they were technically one company, and he put both of his signatures on the Hulu side and a signature on the Fox side, and they were not happy about that in arbitration. So yeah, so they ultimately won.
So we're gonna pause for a moment. I see Christina coming up.
Yeah, I'm just creeping up and it has to be every class for 5 minutes, 1 minute in terms of questions, and then Dr. Holmes' class will leave, but if you have other questions, they will still be here. And I hate to tell Dr. Holmes' class, but also there will be pizza on the ears. So I have that kind of thing. So so questions for economy, and then we can continue with questions after Dr. Holmes' class has to get.
So how does one get into your profession? What does a successful candidate look like for recruitment and long-term employment? And what does an entry position look like?
I can answer that.
You sure you want Raul to talk about it?
Well, no, I mean, not a successful one. No. I think he's referring to coming on college, right? So, you know what? I'm going to let you answer that question.
Well, I did the accounting program here at CSUN. I eventually got an internship with PwC. Like I was saying, that's kind of where I learned a lot about financial reporting.
What is PwC?
PricewaterhouseCoopers. That's a Big Four auditing company. And then a recruiter reached out from GHJ. I didn't know anything about profit participations. I just knew GAAP accounting and financial reporting. But when I interviewed and I was trying to learn more about the practice, I was like, well, what am I bringing? What are you looking for? Things, basically my background at PwC helped me with testing, making sample selections, making requests from studios. But when I joined and, I eventually kind of learned more about the practice and, how we do things and how it's different from auditing. I think something that I see that, helps a lot of our associates is being able to kind of interpret and read agreements and contracts really well, being really creative, having a pretty good questioning mindset, I would say, kind of question everything okay, well, you reported 100 million and it actually ties to your statement, but is that really fair? Is that what you should have done? That's the type of mentality that you kind of need to really succeed and, bring a lot of value to the client.
Yeah, and I'll just add, because I'm actually in charge of the recruiting and the hiring and all that stuff for our department. So that's typically one of the things I look for, or that we always talk about, is it's you have to think outside the box. You can't kind of come into what we do and expect to follow, well, just because, you did it this way on the last job, why can't we do it on this job? Well, every statement's different. Every contract's different. Just because it worked at one doesn't mean it's going to work here. So you have to constantly be thinking, does this actually make sense? Is it fair? Finding the creative ways to kind of find claims for our client, ultimately.
Being tactful, knowing how to speak to the studio. Yeah, definitely. Like I said, I struggled with it coming into the firm because I had such a check the box mentality. That's how, we did things at PwC. That's how a lot of auditors do things. I kept telling myself, I have to think about, bringing value to my client. I kept thinking about is this fair? How can I, make his or hers, share at the end a bigger number? Where can I, if we increase revenues here, how's it gonna, how's the waterfall gonna look after that? So yeah, like Heather said, you just have to have that questioning mentality and never think this is gonna be the last audit. No, you have to kind of come in.
Do a lot of
Bring in your experience, but think about it you're starting from scratch.
And also, I think all three of us do have a background in accounting, and we graduated in accounting. You don't have to have a graduate in accounting. If that was, we we have people in finance, we have someone in sociology. Like really, realistically, like I think it's sociology, but they started at a studio. You know what I mean? So it's you can also come in like from a studio. We have someone that just started with us recently that we plucked from a studio. So she did like statement prep and stuff in the studio. And we're like, cool. You know what terms are? Come work for us. So it doesn't necessarily have to be an accounting background.
When you say it doesn't necessarily have to be an accounting background, what do you think's like kind of like a preferred background if there is one, right?
I mean, accounting or finance or like business, that definitely helps because you at least kind of have the structured mindset of like Excel and math and like in contracts and stuff that we're looking at. But again, at the end of the day, like if you're like the type of person who can look at who does know how to work with massive spreadsheets and kind of do all that stuff, but you also happen to be on more of the creative side. I mean, like that's fine. You know, you're interested in what we do from a different level, but you still kind of have to have that structure.
I think you were waiting so patiently, but I want to just tell you two things that I just want to highlight that you heard from the two of them. To do the work we do, you have to deal with adversarial relations. So you're auditing a party that doesn't want you to be there. So number one. Number two, curiosity, and which is really the driver, I think, of all of our minds. The forensic mind is you're looking for anomalies, you're looking for something that doesn't look and feel right, and then you go a little deeper and you're curious about it. So I think that's the attributes that really matter. But you said it both. I just want to kind of bring it home. Do you want to just, you're so patient, so you go ahead.
Well, I was curious because it seems like this process is very long from getting in the queue to the actual audit. So I was curious about when the talent like receives money and like what? So do they have to wait until the entire auditing process to receive like their entire share, or do they receive the share that's initially offered to them? And then after the audit, they receive whatever has been.
So great question. If a statement is paying, so if it was like the participant A that we were showing you, where the waterfall is making money and they get a percentage of that, they'll get their check for that. That's their statement that they get, where the studio will cut them a check. Hey, we owe you this amount of money. If it's not paying, you're not going to get anything for that at all. And so then to get money, to get additional money that comes out of the audit, you have to wait until settlement. So anything that's above and beyond or that would add to kind of their statement number, that's going to come when we're all done wrapping it up.
And to touch base back onto the employment element, I'm still not really quite understanding the hierarchical aspect of your guys' field. Like CPA is the top, I guess, and then you have like your bottom of the hierarchy. Like I want to understand the business model a bit.
So most of us actually aren't CPAs in our specific department. We're more CFEs. So that's certified fraud examiners.
Oh.
Are you?
Yeah, I'm studying for my CPA.
No, but are you a CFE yet?
I am.
Oh yeah, okay. So,
CFE.
I don't know. Everyone's has different paths. So I'm a CFE, he's a CFE. So most of the stuff we focus on is more fraud related, even though we don't like to use that term. But that's because that comes from that consultative mindset. We have like Alon's a CPA. We have a few CPAs, and so that's technically like the hierarchical high, but we all kind of, there really is no true hierarchy in our group. Like we all kind of work together.
I'm just trying to understand like what's like the entry position for this.
Let me answer because I know we can talk about that offline.
Okay.
Say we bring in typically 1 or 2 interns a year. We end up hiring 1 or 2 a year, and I think our firm is actively involved here at CSUN. I don't know if you've seen the name Green Harrison Jenks or GH Dave for as long as even when I graduated. Didn't hire me though. For both of them.
I think you did okay for you.
It took me a few years to get it.
You made it eventually.
All right, let me pause for a second. Are you okay I don't know if there's any other questions from your class actually.
I don't know, you have the questions, any students in my class? We have?
I have one.
Go ahead, Subajas.
It was just.
Perfect. Of course, thank you.
So it is. Dr. Wolf's class will move out, but then my other friends, development and people getting extra credit and things like that, and also just general interest, stay for a couple more minutes, and then ask your questions, right? So if there's anything else about profit participation, all that kind of thing. And my friends are leaving. First of all, say thank you to them.
Thank you.
Thank you, guys.
Hope y'all came because we were interested, and
Extra credit's good too. I've been there.
It's the end of the term. Extra credit's very meaningful.
And pizza.
Right now. And pizza is very meaningful. So, for my friends are still here, any questions? And so now we can also open it up a little bit too, in terms of not necessarily directly off of the presentation, but yeah, please sit. There's usually a lot. There's also a lot. But also if there are questions regarding, oh gosh, but anything that might fall under their wrong in terms of, I know we're talking about profit participation and things like that, and how deals are structured. You can ask various things.
Well, I have a question on the one of the slides. It says average ancillary at the far end of the bars. What does that mean?
Sure. That could be like non-theatrical revenue, merchandise, music, anything that's kind of outside of what would be like the typical streaming. So all the extra ancillary stuff that's gonna come in that you can make revenue off.
Think of a film like Sound of Music. That line is
Or music, yeah.
a lot bigger than. And I think of another film like Fast and the Furious may not have as much. It's not a lot of music.
Okay. Wiki bringing up House of Breeze, so like it is another one. I don't know if you guys even touched or not, but it's Sound First. That one is solely music and sound. How would have that one worked through Darius or kind of like First Hand Breeze? I didn't ask that one really just like anything like that is.
Good question. Yeah, it all definitely depends on the contract as well. Like if a studio or a participant holds back their rights for music stuff where they're kind of like getting a separate statement and doing all that on their own, that's not going to be incorporated into the main statement. If it is, then there's going to be a big line item on the statement for music soundtrack, music recording, and then we'll see the statements that come in from the third parties, which is typically Sony, Universal, like whoever kind of does the soundtrack or the recording for that those monies will come in from their departments, that they'll take their own fees and stuff on top of that, report it to the main studio, which in your case would be Warner Brothers, and then that will be kind of come a part of the whole waterfall. Yeah.
Be real. I dealt with like people kind of do like embezzlement.
It's interesting. No, I was going to say, let me go back to what we do for a living first. Yeah. We get paid by our client. It's very ROI driven. So we get paid by our client to determine if they got paid properly, right? So it's a one-sided audit, and we're using all of our experience to find as much value as we can. And it's, you think about, if you remember that statement that Heather went through, you got the revenue and you've got the cost. And at the bottom, you get a fair share of whatever that's. So what we're looking for is under-reporting of revenue or over-reporting of deductions, right? If we come across an issue, we still have an obligation that may be fraudulent. We have an obligation to share it with our client, and then with the client's permission, we then share that with the studio if there's an embezzlement or a fraudulent matter. But we always have to go back to our client first.
You mentioned during presentation also that the distribution costs were going higher than previous ones. So my question to you would be, how do you like prove that that's justifiable? Or it's just like a made up number that they're telling you?
How do you determine if somebody's fraudulent?
Well, no, let's not use that word, because that's the word. How do we determine if it's improper?
Right.
How do we determine if it's improper? That may be the better.
Yeah, or go ahead. It's a fieldwork question. Okay. So during the course of fieldwork, we'll get like I said, we get the general ledgers that have all the transactional detail on it that shows who paid what at what time. It's like basically their SAP Excel spit out file that we look at, and we organize it and do whatever we need to do. And so from that, we typically make sample selections. So we're not going to look at every single cost, but we'll take a look at certain categories that we think look weird or really high amounts, or, typically like if they paid Facebook $1 million to advertise it, but the client is saying they never saw that this got advertised anywhere, like we want to take a look at that and make sure it's actually proper. So we'll typically select, depending on the studio and depending on our scope procedures, we'll typically select like 30 to 75 or something like expense selections, and then from that we send it to the studio. They give us back actual copies of invoices, so we go through and we say, okay, this invoice matches the date, matches who it's supposed to be paid to, it mentions the title. A lot of times they'll say a different title on it, or it won't even mention the title at all, and we're like, we'll prove that it belongs to us, you know, and we'll question it that way.
Yeah, like the nature of the cost is reasonable. Like when we review like the GL information, something that I would do, I'd try to look at the description and see like, okay, what's this like invoice for? Is it like something that's like miscellaneous? There's a lot of gray. Like, okay, maybe we should review that. There could be some value there. Right.
Mm-hmm.
I got a question.
There's a lot, yeah.
Do you guys use Nielsen data at all?
We can if they're, so we'll look at like Nielsen expenses on the expense side. We'll get Nielsen data when something matters, when it comes to like yeah, it's like if there's like a classification for a certain license fee based on ratings, then we'll ask the studio for the Nielsen data, or we'll look online, or we'll do whatever we need to do, because they may get, you know, one bucket of money if it's like the top 2 Nielsen ratings, or they might get another one if it's later, and it might be a significant amount, so we definitely want to confirm that.
Thank you.
Yeah, go ahead.
I'm having all these questions.
Okay.
So one of the things now with new media is vertical market integration as well as AI. How has that impacted your industry? AI. Well, I have 2 questions. So first question is how have you been attacking with vertical markets? Have you tapped into it yet in your firms? Like, because you have like all these Chinese verticals or verticals in general creating or being popularized, or at least the buzzword is portraying that. And the second question is, how has AI impacted your industry in general, or is it better, for worse, or even in the idea of, yeah.
Very little.
I'm not sure if I followed the first question.
First question is vertical market. Have you tapped into it? Have you had people doing vertical series production? Yeah.
We haven't really touched that. No, that's what I'm asking. But let's focus on AI. So I don't know if you want to. It sounds like you were about to say.
No, I was gonna say, great question. We're live dealing with figuring out AI. A lot of stuff. The industry is kind of has a lot of opinions on it for sure.
Because we're at the Tilly Norwood, and you have digital doubles and negotiations coming up here, and the idea of digital doubles and the way that, because now they're gonna be like, oh, you can just take a bunch of reference of me, and then you can put my personality inside of that film for a fee. I think they're doing that with Bruce Willis or something like that on a recent film. And I don't know how the negotiation process with that is, or what does that look like within your climate?
Yeah, I mean, it's all going to depend on the contract. It's so new that it hasn't really hit any. We don't have any Tilly Norwood films or anything that's kind of coming up yet.
Bruce Willis, they have his likeness right now in one of the recent films.
But that's part of. Well, I mean, it's protected by name and likeness to begin with.
Sure.
More importantly, when I talk with some of the most actually interviewed, Ken Ziffert, if anybody knows that name, was one of the most famous lawyers making deals. The simple concept is, it's all, so long as the client approves, or if they can't even make decisions, like in Bruce Willis's situation, it's all about value and how you get compensated for it.
Right, but I'm
It has
saying,
to be paid for.
have you guys come across the new type of negotiations? That's what I'm mainly asking, not about the process.
That's my point. He's doing that for.
Oh, okay.
Yeah,
Gotcha.
It's too new. You and then you.
I'm more of a terminology question. You keep correcting the word fraudulent whenever it's mentioned, and you may have mentioned this in the presentation. Okay. Sorry, I can't speak. But what exactly are you correcting? Is it like a legality thing where you kind of like where you use the word allegedly?
No. It's a great question. So what we have to think of the objective of the project that we're performing. Okay. The objective. We're going to come across potentially fraud. We may, but that's not our objective. Our objective is simply to determine if our client, whatever the client may be, could be a huge company, could be just one participant. Right? The question is, has that particular client been paid fairly in accordance with the terms and conditions that he or she entered into with that production house and distribution company? We're going to bump into, you're right. So when we come across it, things like that, we don't have time to determine why it happened. We're focusing on, should it have been, if it's an expense, should that have been deducted or not? If there's a revenue issue, why wasn't it reported? But we're going to come across issues like fraud. But what's interesting though, on the litigation side, and this is important to share, the issues that we are coming across are contractually in nature, and rarely those claims that we rise up to the level that is considered to be fraud. So we're trying to focus on where the value is. We're trying to get the work done. But every once in a while, we're going to bump into a potential for a massive corruption issue. Then our job is to communicate that to the client, and then, with our permission, tell us to.
Right. It's also just like, it's one of those, it's a relationship industry. It's also one of those like buzzwords that, you know, they call that the new F word. Like you don't want to throw that term around because, again, like I said before, you know, fraud needs intent. So you're basically, if you allege that, you're telling the studio you're on purpose, like screwing me over, F you, you know, whatever it is. And then you may not, you want, like, a lot of the talent wants the studio to like them. They want to work for the studio. They want they want them to distribute their film. You don't want to necessarily go into some litigation situation unless it's actually going to be like, hey, this is clearly fraudulent. You clearly like screwed me over. We're going to go into this. But if it's like little things here and there, sometimes you kind of just look the other way, honestly. Sorry.
Why don't we make these two the last questions, and then we'll go out and have some pizza. And if you're able to stay around, you can ask for questions afterwards. Sure.
So what I was gonna say was, you said in the beginning that sometimes most of your work is obviously afterwards. You use it sometimes. Participants, they come to you before and ask you if the deal that they're working on is good, or what have they talked to you about before?
Yeah, so that's actually a really good question. That's one of the main things that we tell, or that the recommendations that we give to clients or future clients or whatever is, do anything you can to make your deal good on the front end, because once it's signed and once it's set in stone, you're going to get, you know, not as much leverage on the back end. Once the agreement is there, that's it. And, you know, we can try to argue parts of the agreement, but if it's there and it's written in black and white, we can't do anything. So we try to, we'll have consultations and we'll try to tell them ahead of time, like, hey, we're reading your deal. Before you sign this, you may want to try and negotiate for a lesser distribution fee or a lesser this fee, because then you'll ultimately make more money.
So I was going to say that it gets so complicated, Heather, right? We have, all three of us are dealing with it, that the deal it may not ever get signed.
Right.
So you got version 7A that our client is using, and then they've got
And they're red lines and they're scratched
They
out.
don't even notice that the deal really is.
Yeah.
So sometimes in the finalization of the negotiation is at the end of our audit.
Mm-hmm.
That's how they sell everything.
And sometimes we like when a deal's unexecuted, because then we can say, well, that wasn't the intent. No one actually signed it. We can kind of find more of a gray area with that sort of thing.
We have two back there though, wait.
Yeah. Whenever, based on the contract and you're effective, I'm assuming you have the Excel that you have mentioned is a lot of time. What's your favorite function? The B or D share pivot tables.
Oh my gosh.
We use a lot of pivot tables. That's
Pivot.
I know. Apparently, you just have to be
I love it.
semi good at Excel, and
nice to
you're
have
going to be an
an
expert
Excel.
here. I have become the expert apparently. Yeah, we use a lot of if statements, a lot of pivots, a lot of kind of linking stuff with that. It's anything that can organize a data set into some sort of summary or usable form. We love it. Because we don't want to look at 50,000 lines of
every
data.
day for having Heather on my team because I can't do it.
It's like, you figure this out.
So I love Excel. I like Hydon. Often, all those things are really savvy, especially when you're trying to do production.
Yeah.
We're assuming for your client. Yeah. Wondering that what's your favorite?
Yeah, definitely pivot tables.
Pivot tables, yeah.
Alt NVT. That's not like quick way. Yeah.
Okay. Do you want? That's up to you. I don't mind.
Well,
I can also answer.
Why don't we wrap it up and we'll go and have pizza, but if you're able to join us, you can ask questions directly. So thank you all so much. It's staying up here.
Okay, my friends, if you go out, you know, if Freeze Way, there's pizzas, go eat. I know you guys stood.
That was more information.